Welcome to this video. Today we need to talk about Alibaba. Baba's stock crashed over 30% under 2 months, and there's a lot of fear because of geopolitical risks. The current US-Iran conflict has a larger impact on the relationship between China and the US. And Alibaba is originally a Chinese company. So we're going to talk about the risk as an investor and whether today is a massive buying opportunity or whether you should sell. So buckle up and let's dive right in. So what kind of business is Alibaba? Alibaba was originally always an e-commerce platform, a platform where you can buy and sell products online, similar to Amazon. And it was focused for small businesses to sell products online, business to business and business to consumer. But they have a lot more other businesses as well. This is like the e-commerce group like Taobao, Tmall, and here you have the international digital commerce group like AliExpress, Trendyol, Lazada, Daraz. It's a very big company that owns a lot of different sub-brands. And they also have like a big cloud sector, and that's growing very well right now. And they also have many others like Qwen, which is like the equivalent of ChatGPT. So under values, we can also read that one of them is change is the only constant. So they know that the world changes and they try to adapt. And that's very great as a company, and they are on a very large scale, so they can do that. So it's a very solid business, but let's talk about the risks as well. The market just opened and we're now looking on the charts on TradingView at Alibaba, and we can see it's now trading at $123.46. And we can see that on daily candles, the 50 EMA is still above the 200 EMA, suggesting that we're still in the uptrend, but this is a big correction in the uptrend. So we can see that the waves are extremely large, so there's a lot of volatility, which can be difficult for investors because they see their value decrease of their stock portfolio. And we can see that from top to all-time low, it's like minus 35%. So the question is whether this could be a good opportunity. Well, if we look here at technical analysis and we look here at weekly candles, we can see even on weekly candles, the 50 crosses above the 200 exponential moving average, and it's finding support here at the 200 exponential moving average. So I would say as a long-term investor, this is a great buying opportunity when we just look at the technical analysis. But let's do our fundamental analysis and let's talk about the current geopolitical situation and whether that's going to negatively affect this company and what that means for the long term of this business. So let's continue. So the first risk we're going to talk about is the geopolitical conflict between the US and Iran and how this creates higher oil prices, and this could lead to slower growth. So the majority of the revenue is still made in China itself, although Alibaba is a global company. So we know the conflict is to push the oil prices higher, and higher energy cost is pressure on global and China's economy. So China and Iran are allies, and China imports the oil from Iran, but now it's more expensive, and this could slow down the economy in China. And a slower GDP is weaker consumer spending, and this hurts Alibaba's core e-commerce because the majority of sales is still in China. And this is a fear for investors. So if we look here at the VIX, we can see it's now trading at $25.76. So this is like the volatility index of the S&P 500, the overall market. And we can see there's a lot of fear in the market right now for lower prices because of the tension between the US and China increasing because of the current conflicts in the Middle East. If we look here at the oil prices, we can see that the oil prices have skyrocketed, and this slows down the economy, and this can lead to even to stagflation, which is another fear. And the price has really reflected that as well in the companies that we see. There are geopolitical risks in Alibaba, but there are also structural risks. So let's talk about these structural risks. So the first one is delisting risk. And this risk is much lower now than a few years ago. The fear was really high. So I think this is very unlikely to happen. And when we look at the sentiment, it's also not a big concern at the moment. You also have Chinese regulation, government control. Well, a few years ago, they were really cracking down on these big companies like Tencent and Alibaba. But now they are kind of supportive of it. They're even buying these companies. And I think that's great for the investor. And I think this risk is also mitigated. There's also competition. There are also other companies like PDD, but I think that Alibaba has a very strong economic moat and it's hard to compete with, and I think it's pretty solid. There is a slowing growth in the core business could be a concern, but they're now transitioning to like AI and cloud, and I think that could be the next growth factor for this company, which I'm very bullish on. It's time to talk about the opportunities of Alibaba. And the first one is, of course, AI. AI exploded after 2022. And we can see here the demand in Google searches. And this kind of shows how much demand there is for AI. And every company is implementing it. And I think Alibaba is doing really well with Qwen. And they're optimizing their cloud. And they use AI even in their e-commerce sectors. So this is the next growth factor for the company. So we're currently in the AI boom. And it's just in the beginning phase, and Alibaba knows this, so they're adapting and they're investing heavily in AI and everything they will implement with AI, which we can see here. For example, Alibaba reports solid progress in AI and cloud on the strength of its full stack capabilities. And also here we can read Alibaba launches Wukong, an AI native agentic platform for enterprises. So they're implementing AI everywhere, and this could be the next growth factor for Alibaba. If you want to learn how to master stock analysis like a pro and find winning stocks and beat the market so you can build a portfolio that consistently wins, then feel free to check the link in the description down below. If we look here back on the charts, on weekly charts, and we zoom out a lot, we can see that since its IPO, which is more than 10 years ago, the price hasn't gone on too much. Like if we look here, it's only up like 40%, which is nothing for a high growth company. But the revenue has increased more than 10 times since it IPO'd. And this could suggest that the company is very undervalued. So is the company cheap or expensive? Let's find out. The first thing investors look at whether a stock is cheap or expensive is the price to earnings ratio. A lower price to earnings ratio suggests that the company is inexpensive and there could be a margin of safety. Here we can see on the underbar that the PE ratio, and we can see it's now at 18.75. And we can see that the stock price is at 134. This is not 100% up to date, of course. But this shows that the PE ratio is relatively low if we look at the average of the last 10 years, which could suggest that this company is still cheap. So the stock price went up, but the PE ratio stayed the same, which shows that the company could be undervalued. A more accurate way to find the true value per share of the company is to use an intrinsic value calculator. And this one is based on Warren Buffett's own earnings, and it's like a discounted cash flow model. And here you can fill out all the numbers here on TradingView. Everything is nominated in billions of dollars. And we are going to use a growth rate of around 6 or 7%. So I will use like 6% because if we look here at Alibaba here on Finviz, we can see that the earnings per share based on analysts is expected to grow at 5.51%. I think this is a very low conservative way. I think they can grow much faster because they expect the growth for the next year 43%, which is much higher. But let's use here, we can see it's 5.51%. If we look here at Seeking Alpha, it's 8.68%. So let's use like 6%. You know, that's like a very conservative measure. We're going to use a discount rate of 8%. And let's find the true value per share. We can see that it's undervalued by 53% based on this calculator and the potential upside of 100%. So the true value per share is around $267 per share. And I think that is very realistic. I think this company is massively undervalued. And buying right now will give you a margin of safety based on these calculations. Here we can see a simple graph showing that a great company always goes up in value over time, but it doesn't go in a straight line. So the stock price is more like there's a lot of optimism, there's a lot of pessimism, a lot of optimism, and now there's a lot of pessimism. So now it's trading at low prices and the true value is roughly around $267. So buying right now would give you a margin of safety based on the valuation that we used in our calculator, which is based on Warren Buffett's owner earnings. We know Alibaba is undervalued, but does it have a strong economic moat? This is very important to know because if we are a long-term investor, we want the company that we're investing in to have a wide economic moat. So what's an economic moat? Well, it's the competitive advantage belonging to a particular business that protects its profit margins from competitors in the market and other external threats. So an economic moat consists of network effects, switching costs, economies of scales, and intangible assets. So here on the investing sprint, we can use the economic moat analyzer to find the economic moat of the company we're investing in. So we type in BABA and we can analyze it and we can find that it has a wide moat. So the overall moat score is 8 out of 10. So it's not perfect, but it's pretty good. And here we can see the strength. So it's large marketplace network effect. It's one of the biggest e-commerce platforms based on gross merchandise values. It has strong brand and merchandise, e-commerce growth driving demand, and leading cloud business in China. But there are definitely risks, like what we talked about this before about the competitors. There's regulatory uncertainty in China, which I think is kind of solved right now. But there's also ADR, VIE, and geopolitical risks. But overall, the score is pretty solid, which is great for long-term investors. So do I personally think this is a great time to buy more shares, or should we panic and sell? Well, personally, I believe that this is a great buying opportunity, and I bought even more shares to increase my position. And I think that we are on the dip of the long uptrend, and I think that this is a great buying opportunity. If we look at the technical analysis, we see it's oversold. It's pretty low right now. And if we look here on weekly candles, we can see also that on the longer trend, the 50 EMA is above the 200 EMA. It's finding support at the 200 EMA. So I expect the market to go up from here. On the fundamental level, I think that the geopolitical risks are mitigated and it's an overreaction, because the US and China both know that if they fight to each other, they will both lose when it comes to business. And they don't want that because they're very dependent on each other. So I don't think that the tension between the US and China will not increase exponentially. And I think everything will be slightly under control. And I think that Alibaba can grow well in the future. But these risks that we talked about are real, so always make sure you diversify well, have a cash reserve, and always do your own research. This video was just for educational purpose, but if you like this kind of content, feel free to like and subscribe for more videos. And if you want to even learn more, feel free to check the links in the description down below. And with that being said, I hope you have a great day, and I'll see you in the next video.